Most traders believe they lose money because they don't know enough. More indicators, more strategies, more signals. But what if the real problem is the exact opposite? What if it's not what you don't know, but what you refuse to follow? Think about that for a moment. Because every trader, no matter how skilled, how experienced, how intelligent, eventually runs into the same wall. And it has nothing to do with the market. It has everything to do with one rule. And the strange part, you already know it. You've seen it before. You've felt it too. That moment when a trade starts going against you, just slightly at first. You tell yourself, it'll come back. And maybe it does once or twice. Just enough to build confidence. Then one day it doesn't. Now let me ask you something. How many losses in your trading history came from a bad entry, and how many came from refusing to accept you were wrong? There's a difference. A bad entry is part of the game. But staying in a bad trade, that's a decision. And decisions, unlike the market, are fully under your control. Here's the rule. Not the one people like to talk about, but the one that actually separates survival from failure. Cut your losses without hesitation. Simple. Almost insultingly simple. So why don't traders follow it? Because it's not a technical problem. It's psychological. You're not fighting the market. You're fighting your own need to be right. And that need is expensive. Let's break this down. When you enter a trade, you're making a judgment. You're saying, I believe price will move in this direction. But the market doesn't care about your belief. So when price moves against you, it's giving you new information. Now here's the critical question. Do you adjust to that information, or do you defend your original opinion? Be honest with yourself. How often do you turn a small loss into a large one, because you wanted validation instead of truth? That's the moment the rule gets broken. Not when the trade goes wrong, but when you refuse to respond to it. There's a cause and effect chain here that most traders never fully see. Small loss ignored, position held, gloss grows, gay emotions increase, K decisions worsen, gear account suffers. It doesn't happen all at once. It builds quietly. And by the time you recognize it, you're no longer trading. You're reacting. Have you noticed how the worst trades are rarely planned? They evolve. They start as something reasonable and slowly become something you can't control. Now consider the opposite. A trader who cuts losses quickly. Not sometimes, consistently. What happens then? The damage stays small. The mind stays clear. The next decision isn't contaminated by the previous mistake. And over time, something subtle but powerful develops. Trust in your own discipline. That trust is worth more than any strategy. Because without it, even the best system falls apart under pressure. Let me ask you something else. If you knew, absolutely knew, that every loss would be small and controlled, how differently would you trade? Would you hesitate as much? Would you feel the same fear? Probably not. Because uncertainty isn't what scares traders. It's the potential for uncontrolled loss. Remove that, and your entire behavior changes. But here's where it gets uncomfortable. Cutting losses means admitting you're wrong, and not once, but repeatedly. Can you do that? Can you take 5 small losses in a row without trying to get it back? Can you follow your rule even when it feels unnecessary? Because that's where most traders break, not in chaos, but in boredom, in overconfidence, in the quiet belief that this one is different. The market has a way of punishing that belief. Not immediately. That's what makes it dangerous. It lets you get away with it. Once, twice, maybe more. And then, when you least expect it, it takes everything back in one move. Have you ever had a trade wipe out weeks of progress? That's not bad luck. That's the cost of ignoring the rule. Now, let's make this practical. What does cutting losses actually look like in real trading? It's not just placing a stop loss. It's deciding, before you enter, where you are proven wrong. Not uncomfortable. Not uncertain. Wrong. There's a difference. And once that level is reached, the decision is already made. No negotiation. No reinterpretation, just execution. But here's the deeper layer. The rule isn't just about protecting capital. It's about protecting your ability to think clearly. Because once a loss grows beyond your tolerance, your thinking changes. You stop analyzing and start hoping. And hope is not a strategy. So the rule, in essence, is this: preserve your clarity at all costs. Because without clarity, even a good opportunity looks like noise, and a bad trade looks like a second chance. Let me ask you one more thing. If you stripped away all your indicators, all your systems, all your analysis, and kept only this one rule, would your results improve? For most traders, the answer is yes, not because the rule is magical, but because it removes the biggest source of damage: uncontrolled behavior. And once you truly internalize this, something shifts. You stop trying to predict everything. You stop needing every trade to work. You begin to see losses not as failures, but as part of maintaining control. And control, real control, is rare in this game. But here's where it gets interesting. Because knowing the rule isn't enough. Following it once isn't enough. Even following it most of the time isn't enough. The market only needs you to break it occasionally for the consequences to catch up. So, the real question isn't whether you understand the rule. It's whether you can live by it, especially when it feels unnecessary, inconvenient, or even wrong. Because that's exactly when it matters most. And if you pay close attention, you'll notice that the moments you're most tempted to ignore this rule are the same moments that tend to define your results over the long run. A small loss is a decision. A large loss is a refusal. At first glance, it sounds like a simple distinction. But in practice, it's where most traders quietly lose control without realizing it. The market rarely forces a large loss on you instantly. It usually offers you an exit early, subtle, almost polite. Price moves against you just enough to signal that your idea may be wrong. Not definitively, but clearly enough. Now the moment arrives. You see the loss. You feel the discomfort, and you make a choice. Do you accept it, or do you delay it? That first decision is what defines everything that follows. A small loss is clean. It happens quickly. You recognize that your premise isn't playing out as expected, and you step aside. There's no drama in it. No internal debate stretched over minutes or hours. Just a simple acknowledgement. This isn't working. But notice what makes it difficult. It's not the money. At that stage, the loss is manageable. What makes it hard is what it represents. It's an admission that your judgment in that moment was off, and the mind resists that. So instead of closing the trade, you begin to reinterpret it. You look for reasons to stay, a support level nearby, a pattern that might still hold, a feeling that the move is overextended. Each thought seems logical on its own, but together they form something else entirely: justification. That's when the small loss stops being a decision and starts becoming a refusal. You're no longer reacting to the market. You're negotiating with it. And the longer you stay in that state, the more your thinking shifts. What was once a clear setup becomes a personal position you feel compelled to defend. The chart hasn't changed much yet, but your relationship to it has. Now the loss grows. Not dramatically at first. Just enough to make you uncomfortable. Enough to make you watch the screen more closely. Enough to make you think, I should have closed earlier. But even here, you still have control. So why doesn't the trade get closed now? Because something new has entered the picture. Regret. Closing the trade now means locking in a bigger loss than before. And more importantly, it means admitting that you missed your chance to exit when things were still manageable. That realization is heavier than the loss itself. So again, you delay. And with each delay, the decision becomes harder. The loss becomes heavier. The clarity you had at the beginning fades. What remains is tension between what you know you should do and what you hope will happen instead. At this stage, the trade is no longer about analysis. It's about relief. You're no longer asking, is this a good position? You're asking, can I get out without feeling this loss? That shift is subtle, but it changes everything. Because once relief becomes the goal, discipline disappears. You start waiting for price to come back. Not because it's likely, but because it would make the decision easier. You're no longer managing risk. You're postponing reality. And the market has no obligation to make that easier for you. So the loss continues to grow. And eventually, what started as a manageable decision becomes something else entirely, a situation you feel trapped in. The exit is still there, but it no longer feels like a choice. It feels like defeat. That's what a large loss really is. It's not just the result of a bad trade. It's the accumulation of delayed decisions. It's what happens when a trader chooses comfort in the moment over clarity in the process. The market didn't create that outcome. It simply moved. The difference was in how long you chose not to respond. Being right feels good. Being disciplined pays. There's a quiet satisfaction that comes from calling the market correctly. You see a setup, you act on it, and price moves exactly as you expected. It confirms your analysis. It reinforces your confidence. It tells you that you understand what's happening, and that feeling is powerful. But here's the part most traders don't question. What exactly are you training yourself to value? Because every time you chase the feeling of being right, you're shaping your behavior. You start to prefer trades that validate you over trades that simply make sense. You begin to hold on to positions longer, not because the conditions are still favorable, but because closing them would interrupt that feeling. And slowly, without noticing it, your goal shifts. You're no longer trading to manage risk and extract opportunity. You're trading to prove something. Now consider what discipline asks of you. It asks you to follow your plan even when it doesn't feel rewarding. It asks you to exit trades that might still work just because your rules say the edge is gone. It asks you to accept outcomes that don't reflect your effort or your analysis. And most importantly, it asks you to be wrong, frequently and without hesitation. That's not satisfying. There's no emotional payoff in closing a trade early or taking a small loss. No sense of victory. No story to tell yourself about how well you read the market. Just quiet execution. So the conflict begins. On one side, you have the need to feel right. On the other, the requirement to stay disciplined. And in real time, the two often pull in opposite directions. A trade moves slightly against you. Your plan says exit, but your mind says it's still valid. Give it a little more room. Not because the structure has changed, but because you don't want to be wrong so quickly. Or a trade moves in your favor. Your plan says take partial profits or manage risk. But your mind says, hold it, let it run. You called this perfectly. Not because the conditions justify it, but because you want to maximize the feeling. Do you see the pattern? Being right encourages you to stay. Discipline often tells you to leave. And over time, those small decisions compound. A trader who prioritizes being right will occasionally catch big moves, but they will also hold losing trades too long, exit winners too late, and expose themselves to unnecessary risk. The account might grow for a while, but it's unstable, because it's driven by emotion, not consistency. A disciplined trader, on the other hand, doesn't rely on feeling right. They rely on process. They take trades knowing some will fail. They exit when the edge disappears, even if price later proves them correct. They don't try to capture every move, only the part that fits their rules. And something subtle happens because of that. Their results become repeatable. Not perfect, not always impressive in the short term, but steady, controlled, sustainable. Because discipline isn't about predicting outcomes. It's about controlling behavior. And behavior is the only part of trading you can actually manage. Now here's where it becomes uncomfortable. There will be moments when you follow your rules perfectly and still lose. You'll take the trade, manage it correctly, exit when required, and watch price move exactly in your original direction after you're out. What do you do then? Do you question the rule? Do you tell yourself you should have stayed? Or do you accept that discipline sometimes looks wrong in hindsight, but is still right in practice? Because if you let those moments influence you, you begin to drift. You start bending rules, just this once. You stay in trades a little longer. You hesitate on exits, and gradually, the structure you rely on begins to weaken, all for the sake of feeling right. But the market doesn't reward feelings. It rewards consistency. And consistency comes from doing the same thing over and over, especially when it's uncomfortable, unrewarding, or inconvenient. So the real question isn't whether you can identify good trades. It's whether you can follow through on them without letting your need for validation interfere. Every trade tests your rule, not your strategy. It's easy to believe that trading is about finding better setups, better entries, better indicators, better timing. You refine your system, adjust parameters, study charts, and convince yourself that improvement lies in precision. But when the trade is live, none of that is being tested first. What's being tested is whether you will follow what you already decided. You can have a well-defined strategy. Clear entries, defined risk, logical targets. On paper, everything makes sense. But the moment price begins to move, the environment changes. Now there's uncertainty, fluctuation, pressure. And that's where the real test begins. Because a strategy doesn't fail in theory, it fails in execution. You enter a trade exactly as planned. The setup is valid. The conditions are aligned. But a few minutes later, price pulls back slightly. Not enough to invalidate the idea, but enough to make you uncomfortable. Now what? Do you stick to your plan, or do you start adjusting it? This is where most traders believe they are still following their strategy. But in reality, they've already shifted. They begin to reinterpret the trade based on what they feel, not what they defined earlier. And that's the test. Not whether the trade works, but whether you remain consistent with your rules when it doesn't feel good, because every trade will create some level of discomfort. Even the best setups don't move in a straight line. There will be noise, hesitation, moments where the outcome is unclear, and in those moments, your mind starts offering alternatives. Maybe the stop is too tight. Maybe I should give it more room. Maybe I should take profit early. Each thought seems reasonable, flexible, adaptive, but step back and look at what's happening. You're modifying the rules mid-trade, and once you do that, the strategy you built no longer exists in its original form. It becomes something fluid, something reactive, and something that can't be measured or trusted over time. Now consider the opposite. A trader who treats every trade as a test of discipline. They don't ask, is this trade working? They ask, am I following my rules? That shift changes everything, because now the focus is internal, not external. The market becomes secondary. The primary concern is behavior, execution, consistency, adherence. And here's what most don't realize. You can have a losing strategy and still execute it perfectly. You can also have a winning strategy and fail to follow it consistently. Which one do you think is more common? It's not the lack of strategy that breaks traders. It's the inability to apply it under pressure. That's why every trade matters, regardless of outcome. Not because of the profit or loss, but because it reveals something about your process. It shows you where you hesitate, where you override your rules, where you prioritize comfort over structure, and those patterns don't stay isolated. If you move your stop once, you'll do it again. If you exit early out of fear, it becomes a habit. If you ignore your plan during uncertainty, uncertainty will always control your decisions. Each trade reinforces behavior. So the real question isn't whether your strategy works in the market. It's whether it works through you. Can you apply it when the result is unknown? Can you follow it when the trade is uncomfortable? Can you stick to it when the market gives you reasons to doubt it? Because that's when the test is happening. Not after the trade closes, not when you review the chart in hindsight, but in real time, when the outcome is still unfolding and the pressure is present. And most traders don't fail loudly in those moments. They fail quietly. A small adjustment here, a slight delay there, a rule bent just enough to feel justified. Nothing dramatic, nothing obvious. But over time, those small deviations accumulate. And eventually, the gap between what you planned and what you actually do becomes wide enough that your results no longer reflect your strategy at all. At that point, it's easy to blame the system, to say it doesn't work, to look for something better. But the issue was never the strategy. It was the way each trade was handled. Because every trade, without exception, presents the same question in a different form. Will you follow your rule, or will you follow how you feel in that moment? And the answer to that question isn't decided once. Losses grow in silence while you justify them. They rarely announce themselves. There's no clear moment where a small loss suddenly declares, I'm about to become a problem. It happens quietly, almost politely, while everything still feels manageable. At the beginning, Nothing seems wrong. Price moves slightly against your position. Not enough to trigger urgency, just enough to get your attention. You notice it, but you don't react. You tell yourself it's normal. Markets fluctuate. Setups need time. And that's true sometimes. But here's the part most traders miss. The early stage of a losing trade doesn't feel dangerous. It feels uncertain. And uncertainty gives you space to interpret. So instead of acting, you start explaining. You look at the chart again. You find reasons why the trade still makes sense. Maybe the level hasn't broken cleanly. Maybe volume is low. Maybe the move lacks momentum. Each reason seems logical on its own, and together they create a narrative that supports staying in the trade. But what you're really doing is buying time, not for the trade, but for your comfort. Because closing the trade now would mean accepting a loss before it becomes undeniable, and the mind resists that. It prefers to wait for clarity, even if that clarity comes at a higher cost, so the loss grows, slowly at first, almost unnoticed, a few more ticks, a bit more drawdown, still within reach of recovery, still something you can tolerate, and because it's still tolerable, you continue to justify. This is where the silence becomes dangerous. There's no alarm. No sudden shock, just a gradual shift in your thinking. You stop asking whether the trade is valid and start asking whether it might still work. The focus moves from evidence to possibility, and possibility is easy to defend. You don't need strong proof to believe something might happen. You just need enough doubt to avoid acting, and that doubt keeps you in the trade longer than you planned. Now the loss is no longer small. You feel it more clearly. There's tension. You check the chart more often. You think about the trade even when you're away from the screen. But even here, you hesitate, because now closing the trade doesn't just mean taking a loss. It means admitting that you stayed too long. It forces you to confront not just the market, but your own delay. So again, you justify. Maybe the market is overreacting. Maybe there's news you haven't seen. Maybe this is a false move. The explanations become more creative, more urgent, and the silence continues. From the outside, nothing dramatic is happening. The market is just moving. But internally, the pressure is building. You're no longer calm. You're no longer objective. You're managing discomfort, not risk. And that's when the trade changes. It stops being a position and becomes a problem. Now your decisions are no longer based on structure or rules. They're based on how much more you can tolerate. You're measuring pain, not probability. And the longer this goes on, the harder it becomes to act. Because action now carries weight. It's no longer a simple exit. It's a realization. A recognition that the loss didn't have to reach this point, so you wait. Not because it's logical, but because it's easier than facing that realization immediately. And the loss grows further. What started as something quiet and manageable has now become something heavy and unavoidable. But by the time it feels urgent, your clarity is already compromised. That's the cost of silence. Not the loss itself, but the time spent justifying it. Because every moment you delay, you're not just holding a position. You're reinforcing a habit. You're teaching yourself that it's acceptable to ignore early signals, to prioritize comfort over action, to let uncertainty stretch into damage. And that habit doesn't stay contained. It shows up in the next trade, and the one after that, until eventually, the pattern becomes automatic. You don't even notice the moment where a small loss could have been controlled. You move past it without thinking, already prepared to justify the next stage. And the silence repeats. The trade doesn't need to collapse to hurt you. The first mistake is natural. The second is chosen. No trader avoids mistakes. You can prepare, analyze, follow your process, and still get it wrong. The market doesn't reward effort. It responds to conditions. So the first mistake, the initial misread, the imperfect entry, that's part of the game. There's nothing unusual about it. You take a trade based on a valid idea. The setup makes sense. The risk is defined. But price doesn't behave the way you expected. It stalls, reverses, or breaks a level that should have held. That's the first mistake. It's not emotional. It's not reckless. It's simply the result of uncertainty playing out in real time. And every trader, no matter how experienced, faces it regularly. But what happens next? That's where things begin to separate. Because the market has now given you new information. Your idea isn't working the way it should. Something is off. Maybe not completely invalid yet, but clearly not aligned with your expectation. And at this point, you still have control. You can step out. Reset. But instead, something subtle begins to happen. You hesitate. Not because you don't see the change, but because you don't want to act on it yet. You tell yourself it's too early to conclude anything, that the move might reverse, that the structure isn't fully broken. And again, none of that sounds unreasonable. But look closer. You're no longer responding to what is happening. You're delaying your response to protect your original idea. And that delay becomes the second mistake. Unlike the first, this one isn't given to you by the market. It's created by your decision to hold on longer than you planned. It's the moment where you move from observation to resistance. You've seen the signal, but you've chosen not to act on it. And that choice carries consequences. Because now, the trade is no longer just uncertain, it's deteriorating. The loss begins to expand, and with it, your clarity starts to shrink. What was once a straightforward decision becomes layered with hesitation. You start to reinterpret the trade. Maybe the level will still hold. Maybe this is a temporary move. Maybe you entered too early, but the idea is still valid. Each thought gives you a reason to stay, even as the conditions continue to weaken. And this is where the second mistake grows. Not all at once, but through small decisions that build on each other. You ignore one signal, then another. You widen your tolerance. You shift your expectations. And without realizing it, you've moved far from your original plan. Now the trade is no longer about being right or wrong. It's about avoiding the realization that you've already made a second mistake. Because exiting now doesn't just mean accepting a loss. It means acknowledging that you didn't act when you had the chance. That you saw the change and chose not to respond. And that's harder to accept than the first mistake. So you stay. And the longer you stay, the more difficult it becomes to separate what's happening from what you hope will happen. Your thinking adapts to your position. You begin to defend it, not evaluate it. At this stage, the trade has shifted entirely. The first mistake was about the market. The second is about you. One was unavoidable. The other was optional. And yet, most of the damage in trading doesn't come from the first. It comes from the second, repeated over time. Small decisions to delay, to justify, to wait just a little longer, until those small decisions compound into something much larger, something that didn't have to happen, because at the very beginning, when the first mistake appeared, the solution was simple, clear, manageable, but it required one thing: immediate acceptance. Control risk, and clarity will follow. Most traders try to find clarity first. They study charts, refine entries, wait for the perfect confirmation. They believe that if they can just see the market more clearly, the decisions will become easier. But clarity doesn't come from analysis alone. It comes from knowing that whatever happens next is already contained. When risk is undefined, every movement feels significant. A small pullback looks like a threat. A pause feels like weakness. Your attention becomes hypersensitive because the outcome matters too much. You're not observing the market. You're reacting to it. Now consider what happens when risk is controlled before the trade even begins. You know exactly how much you're willing to lose. You know where your idea is invalidated. You know the point where the trade is no longer yours to hold. That structure changes how you see everything. Price can move against you, and instead of panic, there's recognition. It's either within your plan or it's not. There's no need to interpret every fluctuation, because your boundaries are already defined. And within those boundaries, something quiet happens. Your thinking slows down. You're no longer rushing to protect yourself. You're no longer searching for immediate reassurance. The urgency fades, and in its place, you gain space to observe what's actually happening. That's where clarity begins. Not in predicting the next move, but in removing the pressure that distorts your perception. Because pressure changes how you think. When too much is at risk, your mind narrows. You focus on short-term movements. You overreact to minor changes. You start making decisions based on fear or relief instead of structure. And once that happens, even a good setup becomes difficult to manage. You hesitate when you should act. You act when you should wait. Your decisions lose consistency because they're being influenced by how the trade feels, not by what it is. All of that comes from uncontrolled risk.